Welcome again to the second part of lecture 6. So treatment of goodwill. So goodwill can be positive or negative. As we just recognized in the previous part, how can you calculate goodwill? So if you invest more than the value of the assets of the company, in that case, it is positive goodwill. But if it is opposite, if you pay less than the assets of the company, in that case it would be negative goodwill. So if it is positive goodwill, then we should check whether we need to impair the goodwill, whether the value of goodwill decreases over time. So this is another part of lecture. So it's the details of goodwill chapter actually. So we need to check whether we need to depreciate or impair the goodwill. But in case of negative goodwill, if the goodwill is negative, we have to immediately recognize that loss in the income statement, right? So this is about goodwill treatment. Non-controlling interest, as we recognized in the previous part of the video, we said that if the company purchase all the shares of the subsidiary, if a parent company purchase all the shares of a subsidiary, in that case, it is wholly owned. So that in that case, there would be no non-controlling interest because the parent company own the whole subsidiary. But if the parent company doesn't own the whole company, that means, for example, if the parent company has 80% of the subsidiary, in that case, the remaining 20% is owned by someone else. So the part of the subsidiary which is not owned by the parent company is recognized as non-controlling interest. That is the share not held by the parent company. That is non-controlling interest. So how can we calculate non-controlling interest? So as it is, we recognize all the assets and liabilities controlled are included in the consolidated statements, consolidated accounts. So non-controlling interest equal to amount not owned by the parent company. So how can we calculate, as I mentioned before, how can we calculate non-controlling interest? We can calculate based on the shares. So the shares of the net asset of the subsidiary at the reporting date. So what is the net asset of the subsidiary and what is the percentage of the non-controlling interest? For example, non-controlling interest is 20%. Net asset is 20,000. So 20,000 times 20% or 10,000 is the net asset, for example. So 10,000 non-controlling interest is 20%. So 2,000 is the non-controlling interest. Second method, we can calculate like this: share of non-controlling net asset of subsidiary plus goodwill apportioned to the non-controlling interest. So in that case, if there is any goodwill of the subsidiary, in that case, goodwill should be added with the part of the asset of the non-controlling interest. So let's see example again. On first of or the same, if you see the same company, same picture, but it's in a different name. So on 1st of January 2020, Bird acquired 80% of 10,000 £1 common shares in Flower for 1.5 per share. If this is the case, so what will happen? Bird purchase 80% of 10,000 shares and per share value is 1 but purchased at 1.5. If this is the picture, then what our group picture will look like, an individual company's picture will look like. Let's say here. So in this case, you can see the rose and tulip picture is like this, as we saw before. All right. And in this case, there is a change. as we saw before. It was 8,000 and 3,000, but now it is 11,000 and 3,000 because there is a change in the investment in Tulip. All right. So say Rose Company invest. What would be the Rose Company's investment? Oh, it should be Rose. Okay, Rose Company's investment in uh, in Tulip is as is 12,000, right? So how it is 12,000? Because the company has 10,000 shares, and the company's bird company, if you say it, as we mentioned before. So this company purchased actually 80% of the shares. So 10,000 times 80% is 8,000, and 8,000 they purchase for each share they purchase for 1.5. So 8,000 times 1.5 is 12,000. So their investment in the subsidiary is 12,000. All right. So and this is and the other picture is same as we saw before. All right. But the change here is non-controlling interest. There is a non-controlling interest here that we need to consider. This is the because Rose Company purchased 80% of the tulip, right? Or Bird purchased 80% of the flower. In that case, there would be a 20% non-controlling interest that will come in the group financial picture. All right, this is what we need to consider. So how the figures came, let's see. So it's very simple. It's very simple. Non-current asset 20,000 plus 11,000, as we added before, 31,000, and investment in Tulip 12,000. But this figure is now a little bit different, as we saw in the previous problem. So how this 3,200 came? Um, so this is what we call how much is the investment? Investment is 12,000, right? And out of which 8,000 is for share capital. You can see here what's the share capital of the tulip is 10,000. So 10,000, 80% is 8,000, and retained earnings 4,000, 80% is 3,200. All right. So this is what you are receiving from Tulip because of your investment of 12,000. All right. So the company has this much what is called the capital, what you are purchasing, out of which you are purchasing 14,000, you are purchasing actually 80% of this. So 80%, you are purchasing 11,200, but you are paying 12,000. So how much you paid extra is 800. And this 800 is what? Is goodwill, as we recognized before, right? This 800 is goodwill because you are receiving 11,200 and you are paying 12,000. That means you are paying 800 extra because of the goodwill of the company. This is what it is. This is what it is. All right. And in case of no other things, I think it's clear. What about non-controlling interest? If we look at the non-controlling interest, so parent company purchased 80% of the shares, and remaining 20% is non-controlling interest. So the remaining 20%, so 10,000 multiplied by 20% is 2,000. All right, and 20% of 4,000 of the retained earnings that will go to the non-controlling interest is 800. So 2,000 and 800 is actually non-controlling interest. This is what we need to add in the group financial picture, group financial statement. So if you add these assets together, 31,000 and 800 goodwill and non-current asset 14,000, altogether 45,800. And in case of liability side, as we mentioned before, we need to consider the parent company's part. The share capital is 16,000, retained earnings 27,000, So 43,000 altogether plus non-controlling interest 2,800. That is 45,800. This is what it is. If the company has non-controlling interest, this is how we need to prepare our group financial picture for the bird group, if you say. So as I have mentioned in the previous slide, so how the goodwill is being calculated. So parent company's share in Tulip is 80%, in the retained earnings 80%. So this 11,200 you paid 12,000, so 800 is extra that you paid for the goodwill of the company. And non-controlling interest is how much? As we mentioned before, 20%, right? So parent company is not purchasing 100%. Parent company purchases 80%, so the remaining 20% is non-controlling interest. So non-controlling interest, 20% over the share price, share value, and also retained earnings. So 2,800 is 2,800. That is the non-controlling interest in the Tulips company, in the subsidiary company, that should recognize in the group financial picture. And if you calculate the asset side, so as I shown there is non-current assets 31,000, goodwill 800, and non-current asset is net current asset is 14,000, so 43,800. And the capital and reserve of the parent company only is 43,000. So 43,000 and 2,800 for non-controlling interest is the capital side of the group financial picture. Non-controlling interest is being used based on the fair value. If you consider the fair value is 2,900, then 100 should be considered as the value of goodwill for the non-controlling interest, right? If you consider the fair value is, if the fair value is given somewhere, is 2,900 for the non-controlling interest, so remaining 100 should be considered as the goodwill attributable to the non-controlling interest. Yeah, and then this will be the picture of the group financial picture. So goodwill total will come now 900, 800 for the parent company, and 100 for the non-controlling interest. And non-controlling interest total figure fair value is 2,900. So 45,900 would be the total assets and liabilities of the group. If the fair value and book value differs, for example, the value of an asset increases, then what will happen? So in this example, if we assume the book value of current asset, as we saw, it was 11,000, but if the fair value is 11,600, that is 6,000 increase, then what will happen? So in that case, the parent's share of this 600 would be 480. So 600 times 80%, 480. So that means parent is getting more, increase in non-current asset. So if the parent is getting more, that means the goodwill will reduce. All right. So this is what we can represent in or recognize in the financial statement as, so the value of non-current asset increased by 600, and out of which the what is called the parent company will get 480 extra from the organization. So in that case, the goodwill previously was 800, but now the goodwill value will decrease to 320. So 120 will decrease. Yeah. And out of these um, 600, uh, obviously non-controlling interest is also 20%. So 20% of these will go to non-controlling interest as well. So 120 will go to non-controlling interest, and 480 will go to the claim or the ownership of the parent company. That means the parent company's goodwill will decrease by 300 by 400 and 120. So it will of 480, yeah, the goodwill will decrease by 480 because um, the, the parent company is getting more 480 from the organization. Yeah, so this is how you can recognize it in goodwill value adjustments. So what's the share? Share 80% investment of 10,000, 8,000, as we recognized before, for 80% of 4,000, 3,200. Now the revaluation value increase in non-current asset is 480. This is what um, the parent company is getting. So if parent company is now getting 11,680 and investment is 12,000. So 320 is actually um, the goodwill value that we recognized in the previous slide. Yeah. Yeah, so and also I told you in the main slide before, in the main financial statements, so what will be the changes in the non-controlling interest. So non-controlling interest was previously 2,800, but now because of increasing the value of assets, so 20% of this 600 increase will go to um, the non-controlling interest, 120. So 2,920 would be the total of non-controlling interest. Yeah, so this is what, and the value of asset would be something like this, 31,600, increase 600 total. So previously, parent company 20,000 and subsidiary 11,000 and 600 increase. So the total non-current asset would be reported in the group financial statement is 31,600. Yeah, so how we can recognize the fair value of other items. So for example, if it is inventories, what's the fair value? If it is finished goods, we should say the selling price. Um, Selling price less the cost of sale and reasonable profit. So if we deduct the what's called cost of sale, if we need to sell and need to cost anything, incur any cost for selling and also reasonable profit, if we deduct that, then we will get the fair value of the inventory if it is finished goods. But if it is incomplete goods, work in process, in that case selling price less cost to complete, and then cost of sale and reasonable profit. So yeah, this is how we should recognize the work in progress or work in process. And if it is raw materials, then what is the current market value? If I want to buy it again, that is the replacement cost of the raw materials should be recognized as the fair value. And in case of fair value, obviously, we should think about the arm's length transaction or arm's length estimation, as we mentioned before. That means the fair value measurement should be the price in an orderly transaction. In an orderly transaction, the buyer and the seller should be independent, and obviously between the market participant. It should be between market participant, not by themselves. The transaction should be between two independent market participants. This is what should recognize as the fair value. It should be fair, it should be independent. Yeah, so that's all about our lecture on the consolidated financial statement preparation at the date of acquisition, and hope you understood. And obviously this is interesting, and if you didn't understand anything, obviously we will have chance to discuss further in our seminar, and these are the review questions we will look at and some practical questions as well. And see you in the seminar. Thank you very much.